Good evening, everybody. Thanks very much for coming along. Tonight, we're going to be talking about how to retire early on $2,000 per week from your property portfolio. But before we get started, we have to go through the obligatory disclaimer. I am not an accountant. I'm not a financial advisor. I'm not a solicitor. I don't hold an Australian financial services license. Everything I talk about tonight is of general nature and for educational purposes. Everybody's scenario is different, so please make sure that you consult the relevant professionals before you take any action with information that you find from tonight's presentation. Alrighty, so who am I? For those who don't know me, I'm the owner of Utopian Property and also an affiliate director at Suburbanite. So some of you might know me from Utopian Property and some of you may know me from Suburbanite and some of you might not know me at all. But hopefully by the end of this evening, you will know who I am and what I do. So I am a property investment advisor and a buyer's agent. And I've also been a property investor myself for 23 years. And I have spent a lot of time and money educating myself. For me, the education never stops. I still get mentored in property investing today. You can never know everything there is to know. So for me, it's just an ongoing journey of education when it comes to property investing and everything else in life. If you're not learning, you're dying. So for me, I need to keep learning and expanding my knowledge. And that allows me to share my knowledge, which I love to do with everybody and help people on their investment journey. I've used plenty of different strategies in my investing time, from buy and holds, renos, flips, granny flats, developments, bought and sold properties overseas, and rooming houses as well. And I've also purchased properties across several states across Australia. I've built a portfolio for myself that generates in excess of $3,000 per week. And obviously this evening, we're going to be talking about generating $2,000 per week from property portfolio. I'm also the host of the Sydney Property Meeting. So normally once a month, we'd be holding meetings in Parramatta. Obviously, we're not doing that at the moment with the current restrictions, but normally we would have a guest speaker to talk about investing, whether it be renovations or developments or whatever, even brokers and accountants we get in to talk about, the different things that they specialize in. And also we do a lot of networking, so you can learn from a lot of people there. So when that gets up and going again, hopefully, probably around December, I think, we'll see how that goes. All righty. So on to tonight's topic, how to retire on $2,000 per week from property investing. So tonight we're going to be covering, putting your team together, property selection, property cycles, using equity to build your portfolio, setting some goals and building a portfolio, consolidating the debt, and also I'll show some real life examples. So first of all, putting your team together. Now, you can certainly do some of the things yourself. It's a bit like I say, I can service my own car, but I'd rather pay a professional who does it all day, every day, and to do it right. And I can't stress how important it is to have the right team behind you. It's crucial to your success. Now, I went into more depth about this in a previous webinar, and I'll give you the details of that. So I'm not going to dwell on this because there are people online tonight that were at the previous one. But if you weren't, then you'll get the link towards the end for the previous webinar if you want to go into more details about that. We're going to be talking about property selection. Now, every property that you buy needs to have a reason and a purpose. What reason are you buying that property, and what purpose is it going to have within the portfolio? Right now, a lot of properties go into pretty much one of two baskets. They're either a growth property or they're a cash flow property. You buy it for a particular purpose, right? Now, some properties will kind of sit in the middle, but generally speaking, they're tilted more towards one way than the other, okay? So it's bought for a particular reason. So when you're looking for properties, you need to locate emerging suburbs with good fundamentals. When I'm talking about fundamentals, I'm talking about things like infrastructure, transport, shopping centres, schools, parks, hospitals, universities, and access to employment, because that's where people want to live, right? So they want to live close to all of those things. So you need to look for all of those fundamentals. Also, locate areas that are most likely to obtain quick capital growth. And you can look at things like population growth. Obviously, when the population grows in a particular area, that creates demand for housing. And the more demand there is, it will push prices up. And that's where growth comes from. You only get growth when demand exceeds supply, right? That's what gives you growth. So also, you've got to look at properties that have good cash flow. And I think that's where a lot of people go wrong in property investing, is they focus too much on the growth and they forget about the cash flow. And I'm going to be talking about cash flow later on as well and go into a bit more depth. You've also got to look at things like vacancy rates as well, because if the vacancy rates in the area are high, then what that means is there's more supply than demand, and that will potentially drive rents down, which means that your cash flow will go down as well, right? Whereas if the vacancy rates are low, it means there's more demand than there is supply of rental properties available, and that's likely to push rents up. Focus on properties that are affordable. So in my investing time, I've always looked for properties that are affordable within the location that I'm buying, because in my opinion, if properties are more affordable to the masses, then that means there's more demand to buy that product. And as I said before, the more demand there is, the faster those properties will grow in value. Now, higher valued properties still grow in value. Don't get me wrong, they still grow. But in my opinion, as they grow higher in value and they become less affordable, less people can afford to buy them, then the demand falls away and the growth will slow down. They still grow, but I believe they grow at a slower rate. Also, you need to negotiate well and make money on the way in, right? So as buyers agents, what we do is we create relationships with real estate agents. So if you're doing it, you need to do the same thing. Build the relationships with the real estate agents that in the area that you're looking to buy, because then you can potentially get a heads up on properties that are coming to market before they actually hit market, and you can secure those properties potentially undervalued. Now, just because the property's off market doesn't mean it's cheap. It just means it hasn't gone to market yet. So, but sometimes you can get hold of a property and there might be extenuating circumstances why the vendor needs to sell, and you can get a heads up on that. And quite often you can obtain a discount. So what you need to do is to be ticking all of those boxes. Now we're going to be talking about property growth cycles, and I did go through this in the last webinar as well, but I think it's really important again for what we're talking about tonight. So on average, a property cycle is roughly 10 years from one peak to the next peak. So that's not always true. And I guess it's less true usually in regional areas. The cycle is typically longer in a regional area than what it is in a metropolitan area, because there's just not that demand typically. So generally speaking, it's 10 years. Now, out of that 10 years, 3 years of that is around about growth. So the growth phase is around about 3 years out of that 10 years. And the rest of the time, it's either going sideways or up or down a little bit. But generally speaking, it's around about 3 years is that growth cycle. So what you want to be doing is you really want to be purchasing in a location that's coming into its growth cycle. So, you know, somewhere at the end of the stable sort of cycle and coming into growth. The only way you know that an area is starting to grow is that you see the prices go up. And if you know a market really well and you need to become an area specialist and know what the prices are, you'll see the prices going up in value. And obviously in the Sydney market and pretty much in every capital city around Australia at the moment, we're seeing a lot of growth. Pretty much every capital city is in growth at the moment, which is highly unusual because generally speaking, the markets all move differently. So, but you want to be buying as it's coming into its growth cycle. And then what you want to be doing is riding that wave of growth, because if you can get growth early on when you purchase the property, then what that's doing is helping you to minimize risk. Because if for some reason you need to sell that property 6 months after you buy it, and you've bought it in an area that's getting growth pretty much from day one, you're minimizing the potential for loss, right? So obviously you've got purchasing costs and selling costs that you need to recover when you're selling a property. And if you have to do that in a short time frame, you may not be able to cover all of those. But if you're buying in an area that is getting growth already, you're minimizing that risk of loss. Whereas if you're buying in, say, the correction period or the recovery period, you've got a long time to wait potentially before you start seeing any growth in that property. And it's like putting money in a bank that's going to give you, 0% interest, and the next bank is giving you 3 or 4% interest. Where are you going to put your money, right? You'll put your money in the bank that's going to give you the most interest. Now that will obviously change because the areas change. But yeah, you need to be looking at all the fundamentals to work out, which areas are primed for growth. And there are a lot of areas around Australia that are, obviously, and you want to be getting into those markets. So now we're going to be talking about using equity in your home to purchase your first investment property. And again, I covered some of this back in the previous webinar. But what I do want to talk about is using equity versus, and there's investment equity. So the way we spend money and buy investment properties, number one, we'll use investment equity. And what I mean by that is equity in investment properties. Now, obviously, if you don't have investment properties yet, then you can't do that. If you don't have investment equity, then you use personal equity, and that's equity within your home, right? So we always want to use equity. And then if you don't have your own home and you don't have equity, then the only thing you can do is use cash. We don't want to use cash. Cash is always a last resort. There are no tax incentives for using cash, but there are tax incentives for using equity. So we always want to use equity. Now, when you're starting out, obviously, if you don't have investment properties already, you need to use equity in your home. So in the previous webinar, I was talking about equity and also accessible equity, because you can't access 100% of your equity. So again, I'll give you the details of the previous webinar if you want more details on that. So if we're going to buy a property for $500,000, so an investment property, and we've got $200,000 worth of accessible equity, what we're going to do is we're going to use that, or some of that equity, to purchase the investment property. Now, in the previous webinar, I was talking about using a 20% deposit, and that used up about $125,000 to buy the same $500,000 property. And the reason I used 20% equity or 20% deposit previously was because when we're talking about paying down your home, we weren't going to be buying a lot of properties. We were buying a couple of properties that were going to grow in value to help us pay off our debt on our home, right? But here what we're doing is we're building a portfolio of a number of properties. So we're going to be buying a lot more properties this time around. So what we want to do is we want to conserve that equity as much as we can. So we're going to use a 10% deposit. Now, when you use only a 10% deposit, or you're borrowing more than 80% of the value of the property, the bank is going to charge you lender's mortgage insurance. Now, lender's mortgage insurance is an insurance policy that protects the bank. It doesn't protect you, but the bank will charge you for that. Now, as a rough guide, and this is what I just use as a rough guide, but it does vary, it's around about $2,000 per $100,000, right? So in this scenario, we're purchasing a $500,000 property. So I'm going to be talking about using $10,000 to cover the cost of lender's mortgage insurance. And we're also going to have 5% purchase cost. So obviously 10% deposit for a $500,000 property is $50,000 plus our $10,000 LMI. plus our $25,000 in purchase costs is $85,000. And then what we'll do is we'll get a loan for the remaining 90% or $450,000 of the purchase price of the first investment property. So in this scenario, we've used $85,000 out of the $200,000 accessible equity that we have. So what that means then is that we could actually purchase a second investment property. And remember before in the previous webinar, we used $125,000 out of the $200,000 equity. We wouldn't be able to buy another one using another 20% deposit. In this scenario, we've certainly got enough money to go and buy a second investment property, again, using another $85,000 and getting another loan for $450,000 to cover the 90% loan to purchase the rest of the property, right? So $450,000 loan. So what we do is we put, so now we've got two properties using that 200K. Then if we look at that and we say, okay, let's say that the first investment property increases in value from $500,000 to $600,000. So now we have $100,000 worth of equity in the investment property. Now, as I said before, we can't access 100% of the equity, but what we can potentially do is access 90% of that. So in this scenario, we've now got $90,000 of accessible equity, which means we can then purchase investment property number 3 using that 10% deposit. $85,000 out of the $90,000 goes towards the deposit and the purchase costs. And then again, we get another loan for the remaining 90% of the purchase price and the $450,000. So now we have 3 investment properties. And then, of course, if the same thing happens with investment property number 2, we have goes up to $600,000 and we've got $100,000 equity. We can use $90,000 of that. So now we can then purchase investment property number 4, again, using $85,000 out of the $90,000 equity to purchase that property and get another loan. So you can see how, you can purchase, a number of properties reasonably rapidly just by using equity in your home. And then if you're buying properties that are in a location that have really good growth, then, or they're in the growth phase, then they can grow reasonably quickly, and obtaining that, $100,000 growth from $500,000 to $600,000 can happen reasonably quickly. Can you buy $500,000 properties in a capital city in Australia at the moment? Yeah, you can. You can't buy houses in Sydney for 500 grand, but you can certainly buy units. I wouldn't recommend units at this point in time for investing, but certainly other capital cities in Australia, you can certainly purchase a house for under $500,000 in the metropolitan area. So definitely, it's definitely achievable in this market. Probably lending is a bit of a challenge at the moment, but we'll talk about that. Okay. So we're going to talk about cash flow again. It's so important. Like I said, I believe it's where most investors go wrong. They focus too much on the capital growth and not enough on the cash flow. If you don't have good cash flow, you won't be able to get the loans to buy the properties to start with. You just won't. You run out of serviceability and you won't be able to buy the properties. But you also need the growth, because if you don't get the growth, where's that $85,000 going to come from to buy the next property? So unless you're, on a pretty large income and you can save $85,000 pretty quickly, really the fastest way to do it is by utilizing equity in the properties to achieve that and give you the money for the next purchase price. But you need a blend of both. You can't have one or the other. You have to build a balanced portfolio of both growth and cash flow. So what is cash flow? Cash flow is the rental income minus the operational expenses. So think about obviously your mortgage repayment, council rates, water rates, property management fees, and insurance costs. and also maintenance costs. So they're your operational costs, right? So the ideal scenario is to have cash left over after all the operational expenses are paid. So having cash left over out of the rent. And that's what we call positive cash flow. Now, that's in the ideal world, but sometimes, and you can certainly get positive cash flow, but sometimes if you're getting positive cash flow, you might be sacrificing growth, right? So for most people, you'd want to be chasing growth to give you the money to go and buy the next property, but you still want to have good cash flow. And, you know, in reality, most properties, when you're borrowing 100%, like I showed in the previous example, when you're using that equity, there's a cost associated to that equity, right? So it's not just the 90% loan or the interest on the $450,000. It's also the interest cost on the $85,000 that you use to buy it, because that's equity, and you know there's an interest cost associated to that. So when you're borrowing, you know, 110% of the value of the property, then you know in most scenarios it's going to be negative cash flow. But the key is to have that as close as possible to zero, right? And especially today with a low interest rate environment, you know, that is very achievable. But you need to be very careful. If you're buying higher value properties, typically your cash flow is lower. And what that means is that you'll run out of serviceability a lot faster, right? So, so we'll talk about, this is actually a real scenario. This is a property that we purchased for a client just recently for $500,000. And in this scenario, I'm talking about the $500,000 plus the 5% purchase cost that client had, including lender's mortgage insurance as well. All right, so in this scenario, the property rented out for $420 a week, and that's a 4.37% yield. The average yield in Sydney right now is around about 2.6%, right? So you can see there's a vast difference between the cash flow, and if you're buying a property in Sydney at the moment, it's probably going to cost you a bit more money out of your pocket to hold that property. So, and then we look at, you know, the estimated expenses on this property. So council rates were about $1,600 a year, which equates to, you know, $30 per week, right? When you divide it by 52. And then the water rates were $1,000. So that's just under $20 a week. Your strata fees, obviously there aren't strata fees in this scenario because it was a house, not a unit. And building insurance, about $1,200. So that equates to just over $23 a week. Your landlord's insurance, absolutely need to have landlord's insurance. It's a must. That costs around about $8 a week. Then we allow $500 for maintenance, which is around about another $10 a week. So, and then we have property management. Now in this scenario, property management fees are about 8.8%. That varies across Australia, depending on where you're buying. Sydney's around about 5.5%, but Brisbane is probably 7%. This one was in Adelaide, that's between 7 and 8%. Perth is even more expensive again, sometimes between 10 and 12 over there. So yeah, it just depends on where you're buying, but this was 8.8%, and it equates to like $37 a week. And that's based on a $420 a week rent. And then we're talking about our interest costs. So our interest cost, $15,000 per year, is obviously our major cost. And when we break that down, so this is assuming an interest rate of 3%, and you can certainly get interest rates lower than that at the moment, but we want to be conservative with our numbers here. And it is interest only. So when we're buying investment properties, we want to utilize interest only. Yes, we have a plan for paying off the debt. All right. So, you know, some people like to do P&I, but what we want to do is that we want to keep our cash flow high because we're going to be buying multiple properties. So we're going to use interest only. So we're looking at 3%. That equates to $303 a week. So all up, when we add all of those together, we're at $430 a week, and the rent is $420 a week. So this property is costing our client $10.45 a week. Now, would they be able to hold 4 or 5 properties that are costing $10 a week? Yeah, that'd be 40 or 50 bucks a week. If you can't afford 40 or 50 bucks a week, you probably shouldn't be buying an investment property in the first place. So this is why cash flow is so important. You know, if you bought a much more expensive property and the yield was lower, that number down the bottom could be, you know, several $100s a week. How many of those properties can you hold? You know, if a property is costing you $100 or $200 a week, you probably won't be able to hold that many properties. But not only that, you'll run out of serviceability really quickly, and you'll only be able to buy potentially 1 or 2 properties, because then the banks won't lend you any more money because you don't have the serviceability to pay the loans back. So this is why cash flow is so important. You need that number to be as close to zero as possible. Like I said, in an ideal world, you want it to be positive cash flow, which means you'll pay tax on it. But if you're paying tax, it means that you're making money. You're never going to go broke if you're making money, okay? So don't be afraid to pay some tax. Yes, I know there's plenty of people out there that are on really high tax brackets, but you know, negative cash flow and negative gearing is actually a loss, right? So, but I'd much rather be making a profit than loss. Okay, also with your property management, the fees, like I said, 8.8%. Don't skimp on your property manager. They're worth their weight in gold. They look after the property. They make sure the rent's collected, all of that sort of thing. You know, if you go for the cheapest one, a lot of the time you're going to get what you pay for. So don't skimp on it. Get good referrals by people that use them, and use the ones that have got certainly good what's the word I'm looking for? A good rapport with people as well, right? So, okay. So now we're going to be talking about how do we actually go about doing all of this. So first of all, we need to make a plan. So there's 3 phases to the strategy. Phase 1 is make a plan. So we need to look at, you know, what income do we want to generate? So in this example, we're going to be talking about $100,000 a year or $2,000 per week in income. And we're going to talk about a time frame. So you need to work out kind of what time frame is it that you want to try and achieve this in. Now, you need to be realistic. This is not a get-rich-quick scheme. This takes time, right? And I'm going to be talking about that soon. And the other really important thing is how much can you save towards investing every single week without affecting your lifestyle? And that's really important, because if you're, you know, buying properties and you can't afford to cover that, you know, in that scenario, you know, $10 a week, or, you know, if you build a bit of a portfolio and it's, you know, a couple of $100 a week, if you can't afford that, you're going to put yourself under financial stress, right? You need to understand what is your limitation with cash flow to be able to, you know, support the portfolio. How much can you put aside every single week and still go on holidays with the family, go to the movies, go to the restaurants, do whatever it is that you like to do, and still be able to build a portfolio? Okay, phase 2 is acquisition or accumulation phase. So in the acquisition phase, what we're going to do is we're going to build what I like to call the base portfolio. So this is the portfolio that is going to generate the $100,000 worth of income that we want, or $2,000 per week, right? So $100,000 gross combined rental income across all properties. So let's assume that we purchase 5 investment properties. So we just saw how we could purchase 4. If we add 1 more to that and we purchase 5 properties, and these properties are all renting out for $400 a week, which was the example we just showed at $420. So let's assume these are all $400 a week. So obviously that's $2,000 per week income. Now, the issue is that at the moment, when you do that, most of that income, as we saw, is going to the bank, right? But once we've achieved that and we've built that portfolio and it's generating the amount of income that we want, that's when we move into the 3rd phase, which I call the consolidation phase. And the consolidation phase is all about turning that $100,000 gross combined rental income into $100,000 net combined rental income. And that's where the money is now coming to you and not to the bank. Now, in this scenario, just for the purposes of demonstrating the strategy, I'm not going to be talking about capital gains tax. I'm not going to be talking about purchase costs and selling costs. And obviously, even when you've paid off the portfolio, you still have operational costs, right? Which never go away. So, but I'm not going to be talking about those. I'm just, in general, I'm talking just, purchasing and renting, the rental costs, the rental amount and the purchase amounts. So just to demonstrate the strategy so you get an understanding of how it works and the concept. All right. So there's two ways that we consolidate the debt, because at the end of the day, we want to have a home that is debt-free, and we also want to have a property portfolio that is debt-free. And then at that point, we don't care if interest rates go up to 10 or 15% because we have no debt. It doesn't matter. All right. All we want is consistent rental income coming in. And of course, one of the properties might go vacant here or there. But if I've got 5 properties and one of them goes vacant, yep, I drop a couple of $100 a week, but I've still got another 4 properties that are providing income, right? So I'm not putting all my eggs in one basket. I'm diversifying. So there are 2 ways that we can, or there are multiple ways that we can consolidate debt, but there's 2 kind of different strategies that I talk about. And one of those is what I call the duplicate portfolio strategy. Now, this is quite a passive strategy that you can utilize. And this is where we're talking about, okay, what we're going to do, we've built the base portfolio. We're now going to build what I call a duplicate portfolio that's the same as the base portfolio. So in this scenario, if we purchased 5 properties and they all cost us $500,000 each, then we've spent $2.5 million building that portfolio. So what we're going to do here is we're now going to build a duplicate portfolio that also costs $2.5 million. Why do we do that? I'm sure most of you have heard the saying that property doubles in value every 7 to 10 years. Now, that is not always correct, okay? As I said before, sometimes in the regional areas, it might take substantially longer than that. But you can certainly, in a 10-year time frame, double it. Sometimes it can happen much faster than that. And we've certainly seen that, in the Sydney market over the last, 5 years, since 2017, the peak of the market there, we've certainly seen that happen. So it's certainly not impossible, but you've got to be buying in the right location at the right time, coming into that growth phase. So what we do, we purchased this second portfolio for $2.5 million, so potentially another 5 properties. And then we just sit back and wait, right? 7 to 10, let's call it 12 years. And that portfolio is now worth $5 million. So too is the base portfolio, but the one that we're concerned about here is the duplicate portfolio. Because when that's now worth $5 million, what we're going to do is we're going to sell that down. Now, as I said, I'm not figuring in capital gains tax and all that sort of thing. Obviously, you need to take that into consideration. And that's where your accountant is really going to come into play to minimize that tax, right? But in this scenario, just using baseline numbers so you understand the concept. So let's assume this is worth $5 million now. So what we're going to do is we're going to sell that, and we're going to get that $5 million, and we're going to pay off, obviously, the cost of the duplicate portfolio. And we're still left with $2.5 million, which we are now going to use to pay off the base portfolio. Now all of the properties are debt-free. We're not paying money to the bank anymore. And that $100,000 is now coming to us and not to the bank, and we've achieved the goal. All right, so that is one way to do it. The issue that I see with this particular strategy is the ability to borrow $5 million to build the 2 portfolios. I'm pretty sure in most scenarios these days, and especially with the banks, putting an extra 3% onto, or shadowing the interest rate by 3%, it's going to make it a lot more difficult to get to that $5 million. So, for someone that's got, a large income or whatever, this may not be an issue, but for most people, that's where I see the issue with that strategy is. So there are other strategies that we can use. So we still build the base portfolio, and then what we do is we purchase another property that we're potentially going to renovate. So in the acquisition phase in the base portfolio, these properties are generally speaking buy and hold. It's not as clear cut as that, but they're potentially just straight buy and holds. Whereas the ones that we buy during the consolidation phase, they're trading properties. The ones that we're going to buy and we're going to sell down. So what we're going to do here is we're going to buy a property that we can renovate. Now, it doesn't mean you have to do the renovation. You can always get tradies to do that work for you. So we're going to buy a property, renovate it, add value. This way, we're not waiting for market growth. But again, if you're buying this property in a market that is currently growing, then you're getting a double hit. You're getting the market growth and the add value that you're doing by doing the renovation. Now, what we're going to do is we're going to sell this property down. And when we sell the property down, we're going to take that profit and we're going to pay it down on one of the properties within the base portfolio. We're not going to spread it across all 5. We're going to pay it all down, one lump sum, on one of the investment properties. And you'll see why we do that in a minute. So you can use renovations. You can also use subdivisions. So buy something that's on a larger block of land, subdivide the block, sell the block of land off, okay? And again, take that profit and use it to pay down the debt on that first investment property. Then we can also use granny flats or rooming houses. Now, these won't give you a chunk of capital like the renovation and subdivision strategies, but they will potentially give you surplus cash flow. And again, you can channel that surplus cash flow into paying down the debt on property number 1. And then, of course, we've got a development strategy as well. You know, buy something, potentially knock a house down, build a couple on the back, or keep the existing house and build a couple on the back, sell them off, whatever the scenario. So there's a lot of different strategies. Just get plans and permits in place and on-sell it to a developer. You don't need to actually do the development. So, or hold it for a period of time if it's got development potential, and then on-sell it to a developer because it's got potentially more value because of the development potential. Yeah, and again, we're going to sell that down, use the profit, and pay down debt. Now, once we've paid off all of the debt on property number 1, now all of these properties are renting out for $400 a week. Once we've paid down all of the debt on property number 1, we take the $400 a week in rent, and yes, I know there's still operational costs, but just for the sake of the demonstration, we're going to take that $400 and channel that into property number 2, which is also renting for $400 a week. So now we've got $800 a week going in to pay down the debt on property number 2, okay? And we continue to use these consolidation strategies to pay down the debt on property number 2. Once there's no debt left on property number 2, we take that $800 and we channel that into property number 3. So now we've got $1,200 a week paying down the debt on property number 3, and so on. So what you see now is we're starting to get what we call a snowball effect, where you start to pay down the debt quite rapidly. $1,600 a week going into property number 4 and $2,000 a week going into property number 5 until there is no more debt. And then we're not paying money to the bank. And again, we've now got to that point where our portfolio is debt-free and that income is all coming to us. So what is a realistic time frame for this to all happen? So in reality, you probably can't see that, that's underneath the picture there, but that says 15 to 20 years, right? This is not a get-rich-quick scheme, right? Now, if you don't want it to take that long, there's only 2 things that change here. Number 1, the amount of income that you want, and number 2, the time frame. So if you don't want a 20-year time frame, then maybe you need to reduce the amount of income that you're looking for. And if you want more income, then you need to increase the time frame, because you've got to build a larger portfolio and you've got to pay off more debt, and that's going to take more time, right? So the acquisition phase, can, generally speaking, be done within 6 to 8 years. Again, you've got to be buying the right properties in the right location, and you can use some of these strategies in the consolidation phase to help you build the base portfolio. And I'm certainly going to show you that in the examples after this. So 6 to 8 years, that then leaves you 9 to 12 years for the consolidation phase, and it can certainly happen in that time frame. So I hope that gives you an idea of the baseline strategy and how it works. Yes, as I said, I didn't talk about, obviously the capital gains tax, and because that varies from person to person, obviously. And obviously your main expense is the mortgage, right? So once the mortgage is gone, then reality is that all of that money can now come to you, right? Now, as I said before, once I have no debt, I don't care if interest rates go to 10% because I don't have any debt, so it doesn't matter. And also what will happen is that rents will increase over time. So that 100,000 won't always be $100,000. It will potentially go up to, 120, 150, and so on over time, right? Because rents will also double over time, okay? So the thing I love about this strategy is it actually builds in inflation, because when things become more expensive for the landlord, for example, then typically rents will go up anyway, right? So it does tend to build in inflation. It doesn't, interest rates don't go up and rents go up the next day. It doesn't work like that. There is a bit of a lag, but if interest rates go up, then, generally speaking, what you see is the rents will increase as well, because, the cost is higher, but also what happens is people stop buying investment properties because interest rates go up. Then there's all of a sudden, not as many investment properties being added to the rental market, and there can become an undersupply then. Okay, so let's talk about some acquisition. So this is one of my personal properties in my portfolio. So as you can see, I purchased this, and for those of you that came to the webinar a couple of weeks back, this was the property that I was talking about. I didn't show photos, I was showing contract prices and everything last time, but this is exactly the same property, which I purchased in May 2013 for a purchase price of $270,000. So for those of you that don't know, Amber Vale is a suburb of Campbelltown in Sydney. So I purchased this property, a 3-bedroom home. So you can see there it was not in great shape, as you can see by the kitchen there on the right-hand side. But I purchased this property with a 90% loan, LMI put on top of that. So my total loan was $246,000. Obviously, my deposit was 10%, which was $27,000. And then my purchase costs and my stamp duty, my pest and building and legals, and a few other things was $17,000. And then I did a renovation. So I spent $30,000 on a renovation. So you can see there the before and afters, new kitchen, pretty much everything new in this property for $30,000. And so my total capital invested was $74,000. So that's obviously adding up the deposit, the purchase costs, and the renovation costs all together was $74,000. I then had this property revalued 3 months after I purchased it, and obviously once the renovation was finished, and the bank revalued it at $360,000. And what that allowed me to do was then go back to the bank and say, okay, now I want to increase my loan to 90% of $360,000. It was actually a little bit less than that. The loan was less than that, but increase the loan to $311,000. What that allowed me to do was pull out $65,000. And of course, I used that $65,000 to then go and purchase another investment property. Now, if you were using cash to purchase this property, then you put in $74,000 and you get $65,000 back from the bank. You're now holding a $360,000 asset for only $9,000 of your own money. Right? And this property was renting out for $395 a week when the renovation was finished. So so that was what I did with this. So this was within my acquisition phase. And then this property, still the same property, the Ambervale property, which, as I said, purchased in 2013 for 270. I then sold in 2017 for 565. So we're talking about, can properties double in value in 5 to 10 years? Here's a perfect example of that. 4 years, more than doubled in value. So the reason I sold this property, now, whenever you sell a property, you've always got to have a reason. Why are you selling it? And what are you going to do with the capital from that property, right? Because if you don't have a plan for the money, why are you selling it? Okay, so this one here, the profit from the sale. And again, if you're at the webinar a couple of weeks back, this was the one that paid off the remaining debt on my home, right? The profit from this paid down my remaining debt. It also paid down some debt on my base portfolio. And that what obviously that does is increases my cash flow in the portfolio because my debt's now reduced and my interest costs are reduced. It also provided funds to purchase another property. Now, when I purchased, at this point in time, my portfolio was quite large and I didn't have serviceability, but I still bought another property. So this was the property I bought, which is in a suburb called Narangba, which is up in the Moreton Bay area in Brisbane. And I purchased this property in 2017 for $335,000 without applying for a loan. So as I said before, I didn't have any serviceability. The only way you can fix your serviceability, there's two ways. You either increase your income or you reduce your debt, right? They're the only two ways to improve your serviceability. So obviously by selling down this property, what that enabled me to do, pay off the debt on my home. So now I've reduced debt, but I've also increased cash flow because I'm not paying a mortgage anymore. And then also paid down some of the portfolio, which also meant that I'd reduced some debt and I'd boosted my cash flow a little bit because the interest costs were lower. But how did I buy this without applying for a loan? I used what they call a security swap or a security substitution, loan portability, whatever you like to call it. There's a number of different terms. They all basically mean the same thing. Now, before you go ahead and do this, you need to speak to your broker to make sure that your bank is going to allow you to do that. And my bank did at this point in time. So basically the way this works is when I sold Ambervale, I already had a loan, right, on that property of $311,000. So I didn't pay that loan off. I kept that loan open and then I bought a property where $311,000 was going to be enough to cover the 90% of the purchase price of that property, right? So all I had to do here was put in the 10% purchase price plus my purchase costs to buy the property, right? And then the loan just gets changed over from the Ambervale property to the Narangba property. So that's how you can do it and you can still move forward. So why did I do that? Because today that property is worth $445,000. So what I've done at this point in time, I obviously had no idea that, you know, the market was going to go crazy again in 2020 or 21, 4 years after 2017. But in my opinion, that property had served its purpose. It had doubled in value. It was time to get the money out and put that money into a market that was about to start growing. And that's what I believe this market was doing in Narangba. And I purchased that property and it has started to grow in value. So again, this is a property that I will potentially wait for a bit longer for it to grow in value a bit more, sell it down, take the profit, pay off some debt, right? That's how we consolidate the portfolio. You know, this can still happen today, right? And I showed an example again in the previous webinar of a property that we've built for a client literally 3 months ago that has now, 4 months ago, that has now increased by $45,000 already in that time. So you can certainly achieve this even in today's market. Okay, so one thing that you need to be doing is reviewing and replanning, okay? everything changes, life changes, everything changes. You need to review and replan. So you need to regularly review the vacancy rates in the area. As I said before, if vacancy rates are high, then it's going to take longer to rent the property out and the rents are likely to fall, right? So in that scenario, you want to try and lock your tenants in at the current rent so that it doesn't go vacant, right? You want to offer them another 12-month lease, right? Before it expires. And obviously, as I said, your rents, you want to be looking to make sure you're at or about market rent. You don't want to be over market rent. If you're over market rent, then quite often the tenant's going to go, hey, I can go and rent the place next door and it's going to be 30 or 40 bucks cheaper and you're going to end up with a vacant property, right? A good tenant, as I said before, is worth probably at least $10 to $20 a week, right? If you've got a really good tenant, they're worth 10 or 20 bucks a week. Okay, monthly rental statements, right? Your property manager is managing your property, but you need to manage the property manager, okay? That's your job as a property investor, is to manage the property manager. You need to make sure they're on top of any rental arrears, and also check your rental statements. A number of times that I've checked rental statements and found costs on those rental statements that weren't for my property. You want to be doing that because that can obviously cost you money. And also check your property values, right? You need to be doing that regularly. And one thing I do with my clients is I do an annual review and we go through all of this to check all of these things to make sure that, you know, everything's good. We haven't got any lazy equity that we're not using in properties. And then also check your interest rates. Now, obviously at the moment, interest rates are an all-time low. They're not going to get any cheaper than they are today. But on average, over a 10-year time frame in Australia, interest rates are around about 7%. So, you know, when the interest rates are up, you know, at that level, then potentially you can find better deals. And you can still find better deals in today's market as well, because, you know, all the banks are forever jostling and changing, you know, trying to get some market share. So quite often you can find better deals, but it's not always about getting the cheapest interest rate. Don't get fooled into that, because if you go for the cheapest interest rate, you're potentially going to lock yourself in and you won't be able to extract equity, or you're going to need to refinance, and that's going to cost you money, right? It's not about getting the cheapest interest rate. It's about getting the loan that allows you to do what you need to do, okay? So it's not always about the cheapest interest rate. And obviously, have a chat to your broker. You should be, you know, having a strategy session with your broker every 12 months and going through your loans and everything to see what you can do, but also reassessing your borrowing capacity, where that's at. You know, if you've got equity to pull out, there's no point pulling out equity unless you can get another loan, you know, to cover the remainder of the purchase price of the property. Why would you pull the equity out if you can't do that, right? So this is where you sit down and have a chat with your broker and see whether, you know, where you're at with that. And then also reviewing your insurances. Review your landlord's insurance, review your building insurance. Obviously, building insurance costs go up every year, but sometimes they can go up above where they actually need to be. So you can save money on your insurance policy by, you know, looking at, don't under-insure yourself. Certainly don't do that. But, you know, you can look and make sure that the sum insured is actually a reasonable amount. And also, as you're building a portfolio and you're increasing your debt, you need to look at life insurances and income protection, because if something happens and you can't pay those loans, what's going to happen? You're going to need to sell those properties really quickly. You don't want to be a distressed seller, okay? So you need to do that, and that's where your financial planner will come into play and you know, help you find the right insurances and everything. And then obviously your goals. You know, things change. You know, life changes, everything changes. You need to review your goals all the time, at least once a year. And also your purchase progression, how are you progressing with your goals? Are you on track? And what can you do, you know, to get back on track if you're not? Or, you know, what's your purchase progression? So, you know, they're all things that you need to do. So that pretty much brings it to an end. With the right team behind you, you can absolutely do this. And as I said before, your team is crucial to your success. So you can absolutely do it. As I mentioned quite several times throughout the webinar, This was the webinar I held a couple of weeks back. You can access the webinar via that URL on the screen, or you can simply scan the QR code there and it'll take you straight to the website where you can view that. And that's where I go into more detail about the importance of building your team, your property selection. I also talk about new versus established property, houses versus units. And I also go into much more detailed explanation of equity and accessible equity. So if you want to, I spoke about it a bit tonight, but if you want to go back and have a look at that, that's the link there. So that brings it to an end. Thanks very much, everybody, for coming. Really appreciate you taking the time out to come along tonight. There's my contact details, my phone number, my email addresses. If you know me from Utopian Property, again, you can scan the QR code in blue. If you know me from Suburbanite, you can scan the QR code there in green. And any questions? There's no questions in the chat box. Was it that boring, or no one got any questions? Anything? No? Well, thank you. Thanks everybody for coming along. That's awesome. I hope you found it beneficial. And like I said, if you've got any questions, yeah, feel free to reach out, and I'd be happy to answer any questions you've got. Thanks very much again for your time tonight.